This Friday brings the latest US Core PCE Price Index inflation release out of the US. Of course, this is going to be probably the biggest release in terms of the economic data this week. And therefore, I wanted to take a look at exactly what the implications could be for the likes of the US dollar, the likes of US equity markets as we gear up for this key inflation report out of the US. So, first and foremost, let's see what markets are expecting. The month-on-month core PCE price index figure up to 0.2%. That's from 0%. So certainly last time around, it was good news in the fact that we saw not disinflation, well, not deflation, but disinflation, in that we dropped back down to the 0 mark for the month. And the question mark is whether that's a 1 month blip, whether we're going to start to see those tariff effects come into play. Remember, this is for April here. So are we going to see the reflation move coming into play? Are we going to see the weakness of the economy? Of course, around April, people started to fear a recession over in the US. Is that going to come into play and keep inflation pressures low? Will that lift the expectations of the Federal Reserve to cut rates by a higher degree over the course of this year? These are the key questions. So 2.6% currently in play for the headline year-on-year figure. The month-on-month figure at 0.2% expected, up from 0%, which would be certainly in line with a move towards that 2% mark. You also see, I've kept it in here, the personal income and personal spending. Those figures are also going to be key as a gauge over consumer habits and financial positions in this key month, where, of course, we saw that announcement around the so-called Liberation Day from Donald Trump. So first and foremost, one thing that we have seen recently is we haven't seen an uptick in terms of inflation per se, but we've been seeing a number of the manufacturing surveys providing gauges that the elements that reflect price pressures starting to surge. And you can see that here, right? So the Philly Fed prices paid metric, Empire State prices paid. We've got the ISM manufacturing reading prices element and the Richmond Fed prices paid, but also the expectation of prices paid in the next 6 months, which is significantly higher. So there's an expectation prices will be paid a lot higher than they are at the moment. But also there is a tangible feeling within the manufacturing sector that they are seeing heightened inflation pressures. That may be the case. And by and large, we have seen over the course of recent years that inflation pressures have largely been coming from the services sector, not so much from goods. So maybe this could be a case of we see a little bit of a reflation move in goods, but the sort of perceived weakness around the economy right now, given the big question marks in play, mean that maybe services sector prices ease off somewhat. Perhaps that's how it plays out. We don't necessarily know. You can see at the bottom end of the chart, the core PCE and core CPI metrics moving towards the downside. We don't necessarily have that uptick, and that's going to be the kind of key thing, right? So you wouldn't expect to see the Federal Reserve making all of their decisions in terms of whether to cut, whether to hike, just based on the so-called soft data that we see from the likes of the Philly Fed or Empire State, things like that. But they can be a leading indicator. And so as you can see here, they have diverged away from those CPI and PCE figures. So is that leading the way? Is that pointing towards what could be coming around the corner? So here's a chart highlighting the current state of play. First and foremost, like we saw there, core PCE price index at 2.6. This is core CPI figure at 2.3. So I think that's the headline CPI. And then you can see here on the month metrics in the middle, we can see that in March, we saw a sharp decline in terms of inflation, essentially flat when it came to the PCE metric. And then it's rebounded back towards that 0.2 metric when it came to the CPI figure. And that's what's expected this time around as well. If you look back at April 2024, which is in the middle section on the left, you can see what's going to be dropping out and replaced. It's roughly the sort of 0.2 to 0.3 area. And therefore, that's why we're expecting to see 0.2 on the monthly and then the year-on-year figure remain at 2.6%. And that's because you're dropping out a figure that's by and large the same as what you're adding at the front end. You can see in May, though, that we've got a relatively low number. So there's a possibility we see inflation rising next time around. in terms of the sort of projection, you can see the 8-month annualized figure does point towards inflation moving towards the upside. And that in part is going to be because of the fact that we have got some relatively low metrics that are going to be stripped out, notably in May. And really, if you look at that sort of month-on-month area between November, December, January, February, between those months, they're all sort of quite significantly above the sort of target area. And so really that's when we're going to see another big bout of disinflation kicking in. But of course, that's somewhere where it could be like 10 months away. And so over the near term, I think it's unlikely that we're going to see really significant disinflation. But the question mark here is whether we're going to see significant inflation. So if we're just moving on a sort of current standard trajectory, it's one thing. And then it's a question mark of, when are we going to get to 2%? But if we're in a position where we start to see those inflation pressures build and kick into heavy month-on-month inflation metrics, then of course that has implications in terms of the direction of travel for rates from the Federal Reserve. So this is another way of looking at it. I've sort of stripped out a number of metrics. By and large, this is in the CPI, but of course you're going to see some crossovers in terms of the implications, just the way that some of these, the likes of CPI versus PCE, the way that they're measured and the different sort of weightings that they attach to different things, such as the housing sector. There are differences, but of course, when you're seeing trends within one, you can then sort of point towards that similar kind of trend potentially taking shape over in the other metrics. So we've got a sort of breakdown on some of the core CPI stuff. And by and large here, this is showing a pullback of late for the likes of the shelter metric, for the likes of services excluding shelter. So some weakness. This is actually a 3-month annualized figure. So over the past 3 months, we have seen a pullback in some of these key underlying metrics, notably within the services sector. So like I said, we could start to see goods inflation taking over from services inflation. But some of it's also going to come down to what the perception of inflation is and sort of suffering within the economy. Are people still expecting a recession? Therefore, they could be taking investment decisions or spending decisions along those same lines. So now let's get into nitty gritty of exactly how markets are perceiving things, how markets are reacting at the moment. First and foremost, this is the Citibank Economic Surprise Index. It means that if you're seeing economic data coming out better than expected, then this yellow line should rise. If by and large US economic data is coming in worse than expected, then you'll see this decline. And what we can see here is that we've been seeing better than expected data out of the US. Of course, there had been significant concerns that we'd see a worsening, potentially higher inflation, but potentially sort of weaker economic activity. You can see recently that we saw a better than expected both manufacturing and services PMI. So this has been on the rise. And if you overlay that with the expectation of where rates will be by the end of the year, which is the green line, so essentially where rates will be for the December meeting, that's where you have this correlation coming into play. So that really highlights that right now, rate expectations are being driven by the health or perceived health of the US economy. If the US economy starts to surprise with better economic data, then the expectations of the Federal Reserve to take action ease. And so the expected rate at the Federal Reserve by year end would be higher. So there's a perception that they will have to do less if the economic data is better. So if we add to that the US dollar index, you can see here that we have got that close correlation in particular between the expectation of where rates will be by year end alongside the US dollar. But that's actually seen a divergence of late, which is notable because in part, ultimately, people are growing fearful around the direction of travel for the US economy, irrespective of some of these better than expected data points, the potential breakdown in terms of relations between the US and many of their partners around the world, certainly doing them no favors. And when you're seeing haven demand coming into play in terms of markets, by and large, they're looking for things like gold, not necessarily looking for the US dollar as things stand. So then if you strip some of that out and you just look at year-end rate expectations and you overlay the S&P 500, you can also see that we've got a close correlation between those two. So essentially, if you see an expectation of less rate cuts, markets are feeling positive about that. What does that mean? That means that markets right now are just purely focused on, are we going to see a recession? Are we going to avoid a recession? If we avoid a recession, then yeah, rates will be higher. So, in the past, all markets really cared about was like, how quickly can we see rates cut? But unfortunately, right now, rate cuts also go hand in hand with economic deterioration or the expectation of that. So instead, markets really care about the idea that the US is going to be able to avoid a recession. And also, a lot of that's going hand in hand with a better outlook in terms of tariffs. And so that's an interesting correlation that we're looking out for. How does this all translate into what's happening at the moment? Let's look first and foremost at the US dollar. So better economic data, expectations of higher rates, that has been by and large going hand in hand with a stronger US dollar. That's not necessarily the case at the moment. We're seeing the weakening of the dollar, but it's difficult to know whether we're going to see a sort of catch-up move, whether we're going to see the convergence of these lines once again, or whether we now just have a negative correlation, which is if we continue to see expectations of interest rates to be higher, then we'll continue to see a weaker US dollar. Now, this is what I think will likely be the case in my mind, because what is actually happening a lot of the time here is expectations of higher rates feed into higher yields, and the higher yields, considering the economic position in terms of borrowing in the US and debt, means that the US is in even more trouble when it comes to their finances. Donald Trump, of course, passing through his big, beautiful bill. It may be big, it may be beautiful in his eyes, but for many people, it's another problem, right? It means that the debt burden is going to only grow, and as much of their treasuries need to be rolled over and reissued, it's doing so at a higher rate, and that puts the US in a greater financial difficulty. So that's why I think we're likely to see a continuation of that trend, which is higher expectations of rates by year end. So less cuts would feed into higher yields, and higher yields at the moment are inversely correlated with the US dollar. So that would mean a weaker US dollar. What are we expecting for this inflation report? Well, by and large, markets are expecting it to go up to 0.2, and therefore the year-on-year figure remains steady as is. If we see stronger data, it's difficult to really know whether markets are going to take it as a positive and say, look, we've got stronger inflation. It means that the US economy is sort of running hot. We don't necessarily have too much fear of the direction of travel for the US economy in the same way, and recession fears are fading as a result. But I do think that, if we're looking for rate expectations, if we see a significant pickup in terms of inflation, then that would push that green line higher in terms of where people think the rates will be by year end. And therefore, that could point towards further downside in terms of the US dollar. So in my mind, remember, it's complicated, but I think that a stronger inflation read could provide further downside for the US dollar. Let's jump onto the chart for the US dollar index. And we can see here the dollar index starting to regain some ground of late. We can see a very clear downtrend in play over the course of 2025 thus far. We've dropped back down below. Let's just get this fib off here. And you can see we've dropped through this support level here, 99172. And so for me, I think there's a good chance of what we're seeing here is the continuation of the downtrend. We retrace into the 61.8 fib and descending trend line. We sell off, we break through your first swing low, and then we start to rally. I think that this rally is a retracement of the sell-off from 102, essentially. And therefore, whether it comes into trendline resistance or Fibonacci resistance, I think it's a good chance that it starts to roll over. And certainly if we see strong inflation data pushing up those interest rate expectations for year end or across the board, then I think there's a good chance that that will drive the US dollar lower as a result. Ultimately, a lot of this is going to come down to the chart, right? So look out for this. If we break through 100.118, then that's what points towards a wider retracement coming into play, whether it's trendline resistance or a fib retracement coming into place. Otherwise, for the near term, we are still creating this lower highs, lower lows, but we're certainly getting close to that key swing high that would negate the intraday trend and instead point towards this wider rally coming into play that could quite easily be a retracement for a continuation of that bearish trend for the US dollar. Now, when we're looking at the likes of the S&P 500, let's just jump onto that. So essentially, higher inflation would mean higher rates and potentially a higher equity markets. So will that happen? I mean, look, markets don't necessarily celebrate higher inflation per se, do they? You don't necessarily see that. So, this does highlight the fact that by and large, there's going to be a differential between the economic data that comes out strong, like a better than expected PMI number, or retail sales or something like that. And that points towards a strong economic picture and a lessened need to cut rates. There's a difference between that and a surge in terms of inflation, which could prove problematic for the US consumer and therefore actually point towards future weakness for the US economy. If we look here in terms of the S&P 500, what is clear here is that we've recovered a huge amount thus far. And so the question marks are around whether we have the legs to continue to push and move up through record highs at the moment. Certainly, if we were to see a high economic number from the inflation gauge, then that is a bit of a warning sign because it could mean the potential for weakness in terms of the economy. If we see high inflation, lower affordability, and so consumers suffer as a result. So it's not a given that if we see higher expectation of rates, that it equates to higher S&P 500 when it comes to the inflation metric. So in my mind, I think if we see a significant pop in inflation, that is negative for the S&P 500. And the key thing here is that whilst we're seeing this sort of recovery phase, if we break through the 57, 67 level, then that in my mind points towards us coming into a wider retracement phase and giving back some of the recent gains that we've seen since that post-Liberation Day pop for the S&P 500. So not necessarily a given that the previous relationship highlights that higher inflation should mean higher S&P 500. I think probably likely to go in the opposite direction. So yeah, it's going to be an interesting one. Certainly keep an eye out for this. I hope this has been useful. Friday, Core PCE, that's going to be the big figure to round up what has been another busy week. But by and large, like ever, keep an eye out for the news wires because it's not only the economic data that's moving markets right now, thanks to Donald Trump and Putin and all sorts of other factors. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.